Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with Dakin Campbell. How you doing today, Dakin?
I'm doing great. Yeah, thanks, Kirk.
Great. Well, glad to have you on the show. This is one of those topics that people don't really talk about enough, but they should. To me, it's just a fascinating topic when we talk about IPOs. So, Dakin, tell us a little bit about your background.
Yeah, so I've been in financial journalism for almost 20 years now. I went to Columbia Journalism School and then spent about 10 years at Bloomberg News, learning really the financial markets from the inside out. And then for the last 5 years or so, I've been at Business Insider, and I'm now the chief financial correspondent at Business Insider. And most of my career, I've been writing about investment banks. I've been writing about financial markets, a little bit of private equity, a little bit of hedge funds. So, um, I guess some people call that high finance, but um, really getting into the nuts and bolts of the financial markets.
Nice. So, what drew you to this field as opposed to any of the others that you could have gotten into?
Yeah, good question. When I was at Columbia, it was in 2006, and that was sort of right before the housing market collapsed. And so at that time, business journalists and business journalism was sort of a hot topic and a hot field. And it seemed super interesting to me. It mattered to so many people at that point in time. And so a couple years before, I never would have guessed that I would have gotten into journalism, but it seemed like the right thing to do at that time, um, and I've got an affinity for it, and I've stayed interested in it ever since.
Nice.
I, I
Nice.
went and I even went and got my CFA just to get smarter on the financial markets. Sort of studying on my own time, which is not something that a lot of journalists do to themselves, I don't think.
Don't do that.
Right.
Any journalists listening, don't do that.
That's right.
It's not the way to success. Although I will say that I have a friend who she was in media as well, and she's more in the TV side, and she was telling me she got her CFP because it got her more gigs. Like people were just looking for
Oh,
designations to say like there's millions of people out here who don't know like you don't know if they're any good or not. And you're like, well, you're a CFP or a CFA. Oh, well, obviously you know what you're talking about. Let's pick this person. So kudos for being ahead of the curve on that. But certainly it's a lot of
yes.
work.
Yeah, that's for sure. But
Yeah.
thank you.
Well, cool. So let's dive right in. So your book is about IPOs. So tell us what are the most interesting things about IPOs?
Yeah, so I think a lot of people know about IPOs. They're the first time a company sells shares to the public, and it's the first time you can sort of buy the shares on an exchange. And a lot of people get excited about it because oftentimes those are companies, certainly in the tech industry, that have a lot of growth ahead of them. They also have a lot of risk because of that, because of their sort of uncertain nature of their business model or the industry that they're in. And so I think a lot of people are attracted to IPOs both because you can make a lot of money, but if you bet on the right IPOs, but there's also a lot of risk too. And so I would say that you know, I just told you I've been covering financial markets for almost 20 years. I hadn't really thought a lot about IPOs until 2019 when WeWork, which at the time was the um, I think most valuable private startup, started going for its IPO, and we all sort of know how that worked out. It was a colossal failure, and I was covering that at the time, and just had never really seen anything collapse quite so spectacularly, and that really made me interested in the IPO markets and what had happened to WeWork and really interested in sort of why everything had gone so wrong for them.
So tell us what were some of your insights on that? Because that to me is a fascinating time period. I just watched Dumb Money last night, so it's a fascinating time period in the same year. So tell me about that. What kind of happened there?
Yeah, so, my big takeaway from that was that companies are not always well served by their investment banks or their investment bankers. Quick background, if you're going to do an IPO, you have to hire underwriters, which are typically the largest investment banks in the country or the world. And those underwriters help you write the filings that you have to give to the SEC and that you have to show to investors. They introduce you to investors. They help you um, sharpen your pitch to investors, but they also tell you a lot of stories because they want your business. And so WeWork was this case of a high flying company that everybody thought was going to be great. And you had these bankers pitching WeWork for business and sort of telling WeWork that it could be 100, 200, $500 billion company. And that wasn't, at least when it came time for WeWork to tell its story to investors, that wasn't true, right? No, WeWork couldn't find any investors that thought it would be valued at the levels that the investment bankers had told WeWork it would be valued at. And so that I think is just something that companies need to be aware of. I think that's something that people who are buying IPOs and see Bank X or Bank Y's name attached to the IPO just need to be aware of it. There are many different incentives, cross incentives in the IPO market that I'm not sure everybody completely understands.
So can
And
you
so that was
tell?
sort of,
Yeah, can you talk a little bit about the incentives?
yeah. Um, so there's a big conflict at the middle of the IPO market, and it's really housed in these investment banks. They are hired by companies to sell their shares, but at the same time, they also have the investors who are buying these shares are also their clients. So the banks have to serve two masters in the IPO process. They've got to serve these companies and then these investors. But those two masters want two very different things. The company wants to sell shares for as high of a price as it can, and investors want to buy the shares for as low as a price as they can. Buy low, sell high. I mean, that's how you make your money in the markets. And so you really have to be aware of how the banks are serving those two masters in the middle of the IPO to know whether it's a good deal or to know whether each of them are being served appropriately or well. And but the when you start looking at that and that really comes into play it with the price of the shares that's set in the IPO. You come to this realization, and that is like the company hires the banks for this one thing, the IPO, and that maybe that's the only time the company will hire that bank ever, or maybe the only time in a 1 or 2 year time frame. But the investors who are buying the shares are paying the banks every single day. They're paying it in trading commissions. They're coming to the banks for financing. Um, they're coming to the banks for lots of different services. And so if you're a banker and you say, and you have to make a hard decision and you say, whose interest do I need to lean toward here? The client who I'm only going to deal with once, or the client who I deal with every single day, then what decision would you make? And so um, you know, what a lot of critics say, what I found in my book is that oftentimes bankers will side with the investors. And so they will underprice the IPO shares. And that doesn't serve the companies really well. That means the companies are leaving money on the table. They could have raised more money. They could have put that's money they could have put into R&D. They could have hired more employees. They could have paid their employees more. And instead, that's going into the pockets of the investors. And so that conflict is really at the heart of the IPO market. It's why a lot of people say that the IPO market is broken. Um, and that's really what I explored in my book and in all the research I did ahead of it.
Did you get into the aspect where these investment bankers also have research divisions, which are primarily there to support the investment bank? There was a good book called Full of Bull I read in the early 2000s from a institutional analyst who talked about basically his job was pretty much to promote stocks that they were trying to get investment banking business from. So in your experience, how does that kind of played into the mix as well?
Yeah, so I do get into the history, right? So before 2003, the research analysts basically worked with the investment bankers to pump up these companies. Since then, in 2003, there was a big settlement with Elliot Spitzer when he was the attorney general, and the SEC and others that basically prevented research analysts from being as involved in the IPO market as they had been. And so, from what I understand, they are less involved these days. Um, but and so I guess there is less conflict. But there is this sort of weird thing where a company doing an IPO isn't really allowed to communicate their numbers directly with investors. And so what they do is they communicate their numbers to research analysts who are going to cover them. And then those research analysts take those numbers and they sort of muddy them up a little bit. And then they write those numbers into their research reports. So, one of the people, Barry McCarthy, who was the CFO at Spotify when they did their direct listing and is now the CEO at Peloton. I think his comment is like it's a kabuki dance. The company sort of gives these projections to the research analysts. The research analysts then, give the projections as if they're their own to investors through the reports, and it's just not a real efficient or transparent process. So they're still involved. I don't think they're as conflicted as they were before 2003, but they certainly play a part here.
Yeah, so I recall in the late '90s, early 2000s, before that incident with Spitzer, um, I remember the situation. I was at PaineWebber at the time, acquired by UBS, and that was a big part of it. It was like you wanted to get a part of the big IPOs, and that's how you got new clients, by promising them shares of an IPO. And I remember it was Kraft. I think it was Kraft. It was like the biggest one at the time, and everyone got some. I think I got like 500 shares. Like everyone got a piece. I didn't get a big piece because I was a small fish at the time, but everyone wanted a piece, and it didn't do anything. And there were plenty, that was in the internet bubble when you bought on the IPO and you were guaranteed in air quotes to make a few 100% return if you got shares in the IPO, and that was your ticket to getting new clients. Is like, hey, I can get you access to this company that's going public. I can get you access to this. And at some point, I think it was right around there, '03, that all went away. You weren't allowed to, you were allowed to provide it, but it wasn't attractive anymore. And I forget exactly what they did, but you recall like that period and kind of like what happened?
I don't recall it. I did a bunch of research for the book, and I do recount it. But yeah, there was a lot of handing out of IPO shares to favored clients. It's how people sort of derive their value, getting access to the shares, like you mentioned. I mean, everybody's probably knows Frank Quattrone. He was criticized. I'm not sure he was ever convicted of it, but he was criticized for, I think it's called spinning. It may not be spinning actually, but he would give shares to potential clients and basically put them into their personal trading accounts. And then 6 months later, when the CFO who'd gotten some who'd made some instant money from one of Frank's earlier deals, was deciding which bank to hire. Lo and behold, he would hire. Oftentimes, he would hire Frank Quattrone's bank. So that happens. That definitely happened a lot back then. It's much more quiet, but it still happens these days. I mean, the banks are one of the ways that they prove their value to their investing clients, either mutual funds or hedge funds, is by guaranteeing them that they will get some IPO shares. And so you've got hedge funds that pay a lot of trading commissions to the banks, who are getting, 1 million shares, 500,000 shares in this tech company that maybe they don't know anything about or haven't done much research on, but they're just hoping that it will pop on the first day, the first few weeks, and they'll get some instant money. And the hope among the bankers is that that hedge fund client will remember they made that money on those shares and bring more business to the bank. So it's complicated. It's not
Yeah.
it's not a great thing. And when you talk to, as I did, when you talk to lots of company executives, they know it and they don't like it, and it just sort of depends on how active the executives are in their IPO process. Uh, how much they push back. So there were a couple executives in the book that I talk about who pushed back quite a bit. They had a spreadsheet of all their investors that they wanted to get shares in the IPO, and the bank brought them a spreadsheet that had all these hedge funds getting a bunch of shares, and the executives were like, "Who are these hedge funds? We never met them. They're not tech investors. We're not going to give them those shares. We're just not." And really pushed back hard on the bank and on the proposed allocation. But then there are other executives that are like, okay, the banks are the experts. Uh, they do these IPOs all the time. This is the only one we're going to do, and they just sort of hand the process over. So it's a continuum.
It's interesting because I remember, I forget what year it was, but overstock.com went public Dutch auction, I believe. And was it Byrne, I think the guy's name is. He ended up getting lambasted by Wall Street. Like they just, targeted his stock price, and there's big short selling. And they went after him because it's an alternative approach. So can you talk a little bit about Dutch auctions? Like why are they not getting more interest? Like I would think that that's like a good, easy way to fix this somewhat broken system.
Yeah. So really, the first big company to use a Dutch auction for their IPO was Google, back in 2004. And at that point in time, it was right after the Spitzer era, and right after Frank had gotten into trouble. And the founders of Google really, Wall Street wasn't high on many people's lists at that point in time. And that was true for the founders of Google. And they wanted to do something different. And even back then, Google's business model was auctioning ads on the internet. And so they thought to themselves, hey, if we're doing these auctions every day, why can't we just auction our shares? And so as they began to um, try to put this process into place, they ran into a lot of sort of entrenched interests. There were the banks who have this IPO process, and they know how it works, and they know how they can reward their various customers. They didn't want to do something new. Um, you had investors who were used to getting shares from the banks, and they knew how the IPO process worked, and they didn't really want to have to learn something new. And then you had the SEC, which is always looking out for the interests of individual investors, and was very concerned about investors getting into some transaction that they didn't really understand how it was going to work. And so all of that sort of conspired against Google, um, so that they weren't as successful as they wanted to be with their Dutch auction. They initially wanted to sell their shares in a range of between, I believe it was 108 to 132. Google ended up selling its shares using a Dutch auction at $85. So much lower than what anybody had hoped. And after that, a lot of those same sort of entrenched forces really spent a lot of time and effort portraying Google's transaction as a failure. And so heading into it, there was all this expectation that if Google can do it and if it can be successful, then maybe we can actually get a different way of selling shares to the public. We could sort of create a new mechanism. But because it didn't go as well as Google had hoped, and because it gave ammunition to folks like bankers or institutional investors to say, well, look, they tried something different and, they fell on their face. Um, we should just go back to the traditional IPO model. And so, one of the first moments in time when you could have gotten real innovation and real change in the IPO market was basically shut down. And so it wasn't until 2018 that you had somebody else really try to do it, and that's when Spotify successfully listed their shares directly onto the New York Stock Exchange, um, using an auction process to find the price of the shares, um, and they were off to the races. That was successful, and I think there have been 13 or 14 direct listings since. So, the point I make in the book is that really Spotify uncorked another real period of innovation in the IPO market in a way that Google's transaction was not able to accomplish.
So that's interesting. So Spotify was direct listing. If you think about like the different ways that could be done, there's also SPACs. Like a lot of companies were using SPACs to go public. So can you talk a little bit about that?
Yeah, so a SPAC is really just like a traditional IPO, but the difference is the company that's selling the shares isn't a real company. It doesn't have any operations or assets or people. So the money it raises by selling the shares, it just basically puts into the bank. And then it goes out looking for an operating company that it can buy with that money. And I think it's got some period of time, might be 2 years, 2 or 3 years, and it's written into their prospectus to go and find a target. But then when it finds that target, it it's basically like an M&A transaction. It's already the SPAC is already public, and so it's done the IPO, and it just basically merges with that other company, and the operating assets of that other company then become the SPACs, and that other company starts. They become the same company, and it starts trading on the stock exchange, just like the SPAC shares had been. And so that is an alternative, another way. If you're a private company and you want to go public and you don't want to go through the IPO process and you don't want to do a direct listing, then you could look to tie up with a SPAC. And because the tying up with the SPAC is a M&A transaction, it's got a couple benefits. You can get it done a lot more quickly than you can an IPO, which requires putting together a prospectus with the SEC. It requires talking to investors over some period of time. It's very deliberate, whereas an M&A transaction can come together within just a couple months. The other thing it allows is if you're the private company merging with the SPAC, you can come up with the price of your company basically in a back room, right? You don't need to come up with the price in the public markets like an IPO does or like a direct listing does. Basically, you're sitting down with the people who are running the SPAC and deciding on the price that people running the SPAC are willing to pay for your company. And so a lot of company executives like that ability. Now, I will say SPACs, were very popular a couple of years ago. They're definitely out of favor now. A lot of people lost a lot of money in them, and there are some other embedded features of the SPACs that really allow insiders to enrich themselves in a way that a lot of people don't like. And so that's one reason why they're a couple reasons why they're out of favor now. But the bankers and the lawyers that I talk to still believe that SPACs can become or can be a small part of the overall market. Call it maybe 5 or 10%, because it still does make sense for some companies who have specific objectives that work well with a SPAC.
So you said that there are some ways insiders can enrich themselves with SPACs. Can you elaborate on that? Because I'm interested to hear what that's about.
Yeah, so the insiders of a SPAC are called the sponsors, and not sure how well I can explain it, but basically the sponsors get shares in the SPAC. So, and for very little consideration, their big job is they have to pay 10, 15, $20 million that it takes to keep the SPAC running while it's looking for another target. But when the merger happens, then they get a big percent of that combined company, in a way that everybody else is getting a percentage of that company because they paid money in. The SPAC sponsors are getting a big percentage of the company just by being the sponsors. They don't contribute much money to it.
Okay, that makes a lot of sense. So are there any other innovations that are going on in the space? Because to me, it just seems like this is an old model that you've listed a bunch of direct listing, Dutch auction, SPACs. Are there any others that people are thinking about? Because to me, it just seems weird that with all the tech innovation going on, they haven't found a way to change this, which we're in an era where information is abundant. So it wouldn't be hard to just come up with a new way to do it.
Yeah, so there are a couple of things I'd mention. One is within the traditional IPO structure, a big part of it is the lockup provision. And so the way that works is it basically says that insiders, executives, and employees can't sell their shares in the company until 6 months after the IPO. And so what that ends up meaning is that everybody who's bought the shares in the IPO or in the secondary market can buy and sell during that 6 month period, but executives and employees are locked out. So if you're an employee who's got a bunch of shares in a company and you want to put a down payment on a house, or you've got a big private school bill, or you've got something else, then you won't be able to sell those shares until 6 months after the IPO starts. And a lot of people don't like that for that reason. And a lot of people don't like, because all of that selling can happen at the 6 months, what you end up seeing is the share price in the financial market starts really declining right around that 6 month mark, because everybody knows that a bunch of people are going to sell these shares on the market. And so there's going to be a glut of shares. And so in the last few years before the IPO market shut down, a lot of companies were successful in changing the lockup. It's not an SEC mandated thing. It's a bank mandated thing, an underwriter mandated thing. And so you had some companies allow employees to cash out on the first day, like some percentage of their holdings. You had some other companies decide that that employees and executives could sell 1/6 of their holdings every month through the first 6 months. And so those were real innovations too within the traditional IPO model. And so I think, there's a people are really worried about the IPO market now. It's been closed for almost 2 years. We had like 3 or 4 companies just do IPOs in the last few weeks. But it doesn't look like it's going to open the market wholesale until sometime next year. But when that comes, and I think the first risk taking you'll see in how these deals are structured is probably um, in the lockup. You probably won't see a huge rush of SPACs or direct listings, but you may see traditional IPOs that have non-traditional lockup periods in them. So definitely keep an eye out for that. Another thing that we're seeing is a lot more companies are trying to sell some portion of their IPO shares to customers or clients or other loyal followers. So Airbnb did this when they sold a portion of their deal in December of 2020 to hosts. It's called the directed share program. And there's at least a couple technology platforms out there that are enabling this. So if you're a customer of some tech company that's going public, maybe they'll decide to sell 15% of their shares to their customers, and so that's happening a lot more. And there are tech companies that are enabling that. So that's sort of exciting too, because one thing companies really want when they are selling their shares is they want loyal, long-term investors. And so, who is more loyal and long-term than a client or a customer? I mean, if you've been drinking Coca-Cola for 25 years and you buy Coca-Cola's IPO and you just love drinking Coca-Cola, you're probably going to hold it no matter what the stock does, if it goes up or if it goes down, in a way that some mutual fund manager who's looking at returns is not going to hold it, or is not going to be quite as loyal to it. And so companies want to get more of the shares into the hands of more loyal investors. And so they're called affinity programs, and a lot more companies are um, exploring that. So interestingly, one story I mentioned in my book, just real quickly, is in 1995, the founder of Sam Adams, sort of the original craft brewer, um, was selling his shares to the public for the first time. And he decided, like, he didn't want to sell shares to investors. He wanted to sell shares to the people who were drinking his beer. And so he hung a little tag on his six packs in the grocery stores, and it said, like, if you want to buy, I'm selling shares to the public. If you want to buy some shares, call this number. We'll mail you a securities prospectus, and you'll be able to participate in our IPO. And so he was really one of the first ones to do that affinity program. It went well. I think a lot of those people may still be holding those shares in Sam Adams. Um, and, he did run into some questions with the SEC, but he and his advisors were able to iron out the wrinkles. But um, I just like that story because, that guy was sort of a pioneer, not just in craft brewing, but, was able to sort of look at the IPO market a little differently as well.
Yeah, I remember that. I remember seeing the prospectus. I think I was in college and seeing it and be like, oh, it'd be pretty cool to invest in Sam Adams. And I didn't know anything about finance or investing at that time, but I thought it was an interesting idea for sure. Um,
Yeah.
yeah, so interesting. You've taught me a lot today, because I didn't realize the lockup. I assumed the lockup was an SEC provision. I didn't realize it was a banker provision. Um,
Yes.
I mean,
And, and
to me, it seems like that, if companies are going public, they have a lot of wiggle room to make changes. Are you finding just most companies are just not budging? They're just like, whatever, your bankers do whatever. Is that like the commonplace?
yeah, so what I've really found is that when the financial markets are going strong and everything seems to be going up and has been going up for a while, then uh, companies feel more confident to push back on their bankers. They're not so risk averse. It feels like the chances of doing a deal that falls on its face are much smaller, and um, so they feel more confident to innovate. And when the markets are going up, investors are more willing to buy into non-traditional deals. If they know tech is screaming, they'll buy a company in tech even if it's got sort of a weird lockup that they haven't seen before or something. But when the market is totally closed, or close to being closed, like it is now, there's a lot of fear out there and there's a lot of risk aversion. And so if you're a company that's trying to do an IPO and you need to raise money or you need to sell shares, um, for liquidity or other reasons, then you just want to get a successful deal done. And in that case, you're basically just handing it over to your bankers and saying, like, keeping your fingers crossed, please just, get us out into the market. Um, with a little bit of success, make sure our shares don't plunge, and that will be a successful deal. So when I was reporting out this book, everybody said to me, like, "Oh, this is a bull market phenomenon. Like, all this stuff is going to go away the minute we get into a bear market." And I said, "Well, we'll see. I don't know, but um, the last 18 months have been a bear market, certainly for IPOs. And as I've talked to my sources, they've told me that a lot of these innovations have been put on the shelf again. It's back to traditional IPOs, 6-month lockups. Don't rock the boat. Don't introduce any new risk into these deal structures. And let's just get a successful IPO out into the market. So I do hope, because I like innovation and I like to embrace change, and a lot of the people I spoke to for the book also embrace change. I do hope that maybe next year the market can open up, um, for a sustained period, and we can maybe get some more of these innovations coming back into deals.
Yeah, it's interesting. I maybe the deals are being priced better now, but I remember some very significant ones, Facebook being one of them before it became Meta, where it was priced too high and then it immediately
Mhm.
dropped like 30-40% before it started going up again. And then the other way, which is the way it used to be in the 90s, which is you'd price it at $15 and it would go live at like 50 or 100. And so, I guess the question that kind of comes to mind is, I was doing an interview a few days ago with a guy who deals a lot with the private equity space, and he elaborated on something I was aware of but hadn't really put too much thought into, which is the public markets are shrinking and the private markets are growing.
Mm.
So fewer and fewer companies are going public, and just the ones that are public, they're merging. So there's just a smaller and smaller public market available. And so I wonder if this has come up in your conversations, like what is actually going on in that this is happening? And then is it actually going to change? Like, is this a more permanent structure where the public markets are just broken and people would just rather stay private and not have to deal with all the shenanigans?
Well, I will say that one of the reasons the SEC was so open to the direct listing when Spotify first pitched it to them in 2016 or 2017 is because, the number of public companies is shrinking so much. And so they were really open to any new ideas for how to encourage new companies to become public. So they thought if the direct listing could help 10, 15, 100 companies who would otherwise not choose to go public, then that could be a good thing for for the markets. The other thing, is is really going back to that 2003 research settlement that we talked about at the top of the show. One of the things that created is there are just fewer research analysts now. And so if you are a small or mid-sized company, you are really not getting, um, a lot of great coverage from research analysts in a way that small and medium-sized companies 25 years ago were getting. And so if you're not getting coverage, or if you're a private company and you're somewhat small and you're thinking about going public, and you think you're only going to get covered by 3 or 5 analysts, like that's not going to bring a lot of attention to your stock. It's not going to bring a lot of trading to your stock. And so, um, So like that's not a great thing, or that's certainly not a benefit to you of being public. So I think there is something, there are other reasons why small cap and mid cap stocks aren't being traded as much as they were in the past, that I know sort of less about. But I think if we can't bring more liquidity to small and mid cap stocks and to more of them, then none of those companies are going to want to be public if they have a choice. And so it's only going to be the big guys that end up coming public, and that doesn't end up being a super diverse market, or doesn't end up giving mom and pop investors who are looking for a place to put their retirement nest egg a lot of opportunities for investments. And so it does feel like a real public policy issue to me. I mean, you've got, I mean, if I sat and thought about it, you've probably got 5 or 7 different technology providers that are now trying to start or have already started exchanges for private company shares. And you wonder, like, what's the point of that? Why we've got exchanges for public companies? Why, like, why do we need exchanges for private companies? And it's because private companies don't want to become public. But you just really have to wonder about transparency. There's a good cleansing process that comes about by being a public company. And maybe the executives of that company don't like that, but it's a great way to ferret out fraud. It's a great way to hold companies accountable for poor performance. And so, if you're a private company and you're not disclosing as much as you should or as much as you could, then maybe investors don't get as clear of a picture of your financial performance or what the business model is like as they could or they should. So there are lots of questions. I don't know that I've talked to anybody that's got a great complete answer for how we sort of stem the tide. Um, but I know there are people out there sort of searching for answers.
Yeah, I think, in some ways, when you see situations like this, and we're gonna have to wrap it up here, but I've seen situations like this. You think of like the meme stock, the movie Dumb Money was about. It's like meme stocks, and it's the public just fed up with the status quo, right? Like they were fed up with Wall Street, and then Wall Street one-upped them with supposedly with Ken Griffin and Robin Hood, and some of the shenanigans that went on there, and they're just like, it was like, we know it's rigged. And I think a lot of people are just fed up with that. And so I think in some ways they're eating their own seed corn, right? They're killing themselves by doing this. And yeah, I mean, there's a certain amount of corruption that happens everywhere, but when it starts to get pervasive, then people are just like, I'm not participating. I mean, why would you want
Yes.
to go in the public markets and deal with all the oversight from the SEC and other people, and have to meet quotas every quarter and this and that and the other thing, when you just stay private and just keep doing what you're doing, except for multiples, right? You just
Yeah.
want to cash out. So, well, Dakin, I really appreciate you coming to the show. Any kind of final thoughts, and we just wrap it up here?
Yeah, no, this has been a great discussion. I really appreciate you having me on. I'd encourage your listeners that, if you guys like this conversation, if you found it interesting, there's a lot more in my book, which is called Going Public. Um, please check it out at a bookseller near you. And if not, that's okay too. But, thanks for listening. It's been a good conversation.
Yeah, absolutely. And Dakin, we'll put all that in the show notes. And I mean, this book's phenomenal. I highly suggest the listeners read it. I mean, to me, it's this is how you learn more about the markets and make yourself a smarter investor. So Dakin, really appreciate you coming on the show, and we'll put it all in the show notes.
Sounds great. Thanks a lot, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is, The saying is that if you want the best deals, you have to be in the room. Now you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
That was a great interview with Dakin. I really appreciate him coming on the show and sharing his wisdom with us. Now we're into the panel portion of the show where we have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. How are you today? Good to be here.
Yeah, glad to have you. And we also have our very own Tim Baker. Hey, Tim.
Hey, Kirk. Thanks for having me as well.
Good. Well, good to have you guys, both of you. And let's just dive right in. So, Phil, what were some of your thoughts from the interview?
The IPO market's an interesting market. It's not one that it's easy to make money in. I know personally, I've only participated in an IPO once. I was a customer at TD Ameritrade when they went public, and they offered people that had accounts the opportunity to buy shares. But for most investors, it historically hasn't been an easy market to get into. That's changed a little bit with changes in the market. Now, I thought I love the story that they told about Sam Adams. I thought that was really a great story about how they went and tried to get, affinity members to buy into the IPO. I thought that was a really interesting story too.
Nice. So, Tim, what about you? What are some of your thoughts?
Yeah, my takeaway, and we talked about this a little bit, is similar to Phil's. IPOs are obviously important for the flourishing of financial markets, right? Otherwise, the public has no access to them. The problem is, as Phil just said, the IPO is not always the accessible piece to the average investor. And if you look over time, how much does that matter? It's hard to say. It depends on how the company trades on the first day of trading. But it's typically a relatively small group of investment banking clients or wealthier retail clients that get access to the premier IPOs that have, advantage pricing, things like that. As Phil said, I think there's some improvements being made there. But, the other challenge, as Phil mentioned before we went live here, is a lot of companies aren't IPOing as early as they used to. Everything that comes public at one point was private. But fortunately, there have been some changes to that market as well. But yeah, to me, the IPO market has always been, key for financial markets, but it's been a big question of who gets access to it.
Yeah, I mean, that's an important point. And it's always been this exclusive of the investment banks or brokerage houses. Oh, we got this exclusive access to these IPOs, and they did that as a way to get big customers. And I always found it interesting when I started at Payne Weber when IPOs were really more of a thing, right? After that, after the tech bubble burst, a lot of companies, there was a lot of shenanigans, and that changed a little bit. Back in the late 90s, early 2000s, you still had access to some of these, and some of them were appealing, but there was always this comment like you gave your best clients the IPOs. That was always kind of like the thing. Oh, you have access to Google, you have access to this, you have access to that. Great. Like that's how you kept your clients happy back in the day. And that all changed. I think it was it Altria? And it wasn't Altria. It was
that was a relatively big one.
yeah, I think it was like the early 2000s.
Yeah.
It was Altria. There was a big, I thought it was a food company. It was
Oh, Mondelez?
No. It was something like Altria or Philip. It wasn't Philip Morris. It wasn't a smoking company. It was like anyway, it was a food company in the early 2000s that went, and everyone was like, "Oh, I want access." And when it came out, it was just a dud because everyone had access, and there were so many people wanted it. Like I got 500 shares, and that was basically like, that was the manager saying, "I got to give you something." So 500 shares, that's what you got. And I'm like, so I had clients like 500 shares, like that's nothing.
Yeah.
And so what was interesting is like some IPOs were really coveted and some were not. And what I found is that the culture there at these brokerage firms were, well, if you want access to IPOs, you have to buy them all, right? So you have to buy the good and the bad. You can't just cherry pick. Even your best clients, you can't just cherry pick. You got to have them all. What was interesting is there's some IPOs that came out, and one of them was Annaly Capital Management, so mortgage REIT company. I remember when it came out and I was looking at it, I'm like, this is weird. Like, never seen anything like this. And I don't know if it was the first one, but if it wasn't the first one, it was one of the first. When it came out, I'm like, really? They're paying 15% dividend yields? Like, what the hell's going on here? And it was crazy, and no one bought it. And I remember buying it because people were looking for yield, and it was fine. It did great. It did great through the early 2000s when things were a mess. But I remember that like just no one had any interest. They're all interested in the tech stocks. And I don't want to just do all the riffing here, but I mean, the tech stocks have always been the thing, but they're not always the best investments. So, Phil, what should people be looking for if they're even looking at IPOs, if they're even considering it? Like what kind of IPOs should they look at?
You want to make sure that you understand the company, what its market opportunity is, what it's growth. I mean, I don't think it's all that different than any other company that I would look at as a possible investment. I want to understand what its financial statements look like. Does it have a lot of debt? Right. I want to understand what its revenue is, what its margins are. I want to understand what type of growth opportunities it has. And one of the important things that I know I've missed early on in my career was understanding what the potential market is. Like I remember when I was younger, my mother had breast cancer and passed from it. And I was like, companies that had drugs that could take care of cancer were really interesting to me. And I found this company, it was an early stage company, and I invested in it. But what I didn't know is even though they got a drug approved, it wasn't a big enough market to make a difference. So it was a bad investment. So you really have to understand the market opportunity as well. And management.
Who are allergic to tree bark. That's a powerful drug. Kirk, I was going to say on your point, you have to take all of them. That was, these movies had like kind of a comedic undertone to them, but they were pretty accurate. Wolf of Wall Street and Boiler Room.
Yep.
I mean, there was a fair degree of accuracy to what goes on behind the scenes there. And, you'd have a sales manager come out and be like, okay, your clients made a lot of money in Faro Tech. Now you got to dump this one on them. It's crazy, but to me, like Phil just said, I mean, you want to know what their fundamentals look like, but I mean, this day and age, like who cares if a company has earnings? Earnings has almost nothing to do with the stock price nowadays. I mean, Amazon, their whole principle was no earnings, because their whole objective was keep prices low, take all the business away from their competitors. And now all of a sudden, Amazon raises their prices whenever they want, and they're generating huge profits. But I touched on this a little bit earlier. For people that are thinking about the IPO market, if you have the right credentials in terms of being an accredited investor, we were talking a little bit before we went live about how private equity has become more and more accessible to people. To me, that's where people should be looking is, pre-IPO. before anybody gets access to these companies. You hire a bunch of professionals that have expertise in certain industries. And even though the investor credentials still exist, you still have to have a certain minimum net worth and all of those things. The minimums to invest in these private equity markets has been coming down pretty significantly. I won't mention the name, but we're in talks with a private equity fund right now. The mutual fund version of their private equity fund has a minimum of 25,000. So to me, you can get in a pretty small to mid cap market, either make money on it as they dump it off to somebody who's trying to do private equity with larger companies, or they IPO them. So you're really getting even that pre-IPO growth. I mean, most companies aren't going to come public until they've already gone through their growing pains. Like, you got to have your ducks in a row. I mean, obviously there's listing criteria for stock exchanges. You have to have certain financials in place before you can even list. So getting access to that even earlier growth is a good potential area as well.
Yeah. It's it's funny. The IPO market, what I find fascinating is people get baited by the idea of IPOs, right? If you think about it, like, what is an IPO? It's a private company where the owners have decided, hey, we could really make a lot of money here by IPOing at the peak, if you will, in the short term, and obviously access additional capital. But they're basically selling their own shares, right? So they're selling their shares to the public. So they're cashing in. If anybody's half intelligent, the only time they do that is when when they can maximize their share price. So they're basically dumping overvalued shares onto the public. And what's fascinating is, I mean, if you're looking at like the tech bubble, like leading up to the tech bubble, there's a lot of IPOs, and they turned into bigger companies, and that worked. But if you look at normal, like look at Facebook, for example, when it came public, like it came public and it basically dropped, I forget, it was like 20 or 30% subsequently, because it was way overvalued. And the only reason it started coming back is because they decided, all right, we're gonna institute we're going to actually start charging people for ads so we can make money, because they didn't have a profit model at the time, and people were just like, whatever, like we're out of here. But the point is they overcharged, like on the IPO, and people paid it because they wanted access to Facebook. But I think the challenge with a lot of this is, I was talking to one guy, I usually do this conference once a year, and I was talking to one of the speakers, and he's like, yeah, I just sold my company for X, and it's now 90%, the price is 90% less. It's not that the company is worth less. The company's earning the same amount of money. It's just people overpaid during the SPAC, because it was a SPAC. It was through a SPAC. So, but they overpaid. And I don't think people realize, like, when it's going public, you're overpaying typically, because just the nature of it. And people think that there's some magical thing because of the 90s, like IPOs are great. Like, are they? I don't know. Pre-IPO might be, but IPO, like, just doesn't seem attractive anymore. I mean,
well, it's funny you bring up that Facebook example and the profitability of it. I'll never forget. I was actually at the gym one day when they were talking about the IPO of Uber that was coming out that day, and the CEO of Uber literally said, I don't know, we might never be profitable. And I'm like, hang on. When you own a stock, what do you own? You own equity in the profits of the generated by the company that you own. These guys are telling you there might never be a profit to own equity in, and everybody jumped into the thing. I don't know, the thing's up like 55%. I was looking at it the other day. I don't know. The stock has done extremely well for a company's CEO that literally came out and said we might never generate a profit.
People don't care.
No.
I think, as you said, people don't care about fundamentals anymore, which is fascinating to me, because when I started, it was all about fundamentals. Even in the 90s, like, people didn't care about earnings, but like, you at least respected the fundamentals, right? You may have said, well, I don't need this because I'm just going to put all my money in this IPO that makes no money and will never make money. And you're speculating, and people were at least somewhat aware of it. But now people don't even care. There's plenty of cash gushing companies great companies that are just getting no respect, and they're still expensive, but they're not. I mean, people don't want them. People want, NVIDIA, Apple, Meta, whatever. They want companies that are what's NVIDIA, like 200 PE of 200, something crazy like
something
that.
But
Something
you
like that.
you just nailed, you just answered everybody's age-old question for the last 15 years. That's why value stocks don't ever get any attention anymore. There's lots of great tech companies out there that generate earnings and they're cheap relative to their earnings, but nobody cares.
Yeah.
So NVIDIA trades, actually, it says their price to earnings ratio is 64.
Is that what it is now? It might be. Maybe their earnings just caught up. Yes.
Yeah, I was going to
It's
say
caught up a
they
little
just
bit.
had a big blowout earnings. But yeah, I'm glad you brought up NVIDIA. And Phil, I'd love to hear what your thoughts are on this based on your earlier comments. Nowadays, are people even going to be able to access? So that you would think the next wave of popular IPO is going to be AI companies. But is anybody going to get access to those? Because Apple, Google, Microsoft, all those guys are on the prowl. Are they going to snap up these companies before they can even come public?
But then the question is, are these AI companies even worth it to begin with?
Well, right. And are they going to submarine the companies that are buying them just because they want to be able to say like, hey, we bought this, we made this acquisition to give ourselves AI growth. And we didn't even know whether or not it was a good company when we bought it.
That's like the tech boom, right? When we had all the .coms, right? Anything that had .com in its name, like companies would intentionally put .com in their name just because it would make their stock price go up.
Who was the company? It was like they had nothing to do with the internet or technology. I'm exaggerating, but it was like
there were a ton of those.
Nabisco changed their name to Nabisco.com.
Yeah.
Yeah. There were a ton of those companies out there back then.
Right.
They were like something like internet or .com, or there was some sort of like allusion to this is a tech company, and it's clearly not. It was I forget what the company was. It was like a packaging company or something crazy. Like it had absolutely nothing to do with the internet.
I feel like that's what I was going to say. It was like something to do with mail or packages.
Yeah, I think you're right.
Like yeah.
The other thing, we talk about access, like that's what's really changed too, is the times that when in their life cycle company comes public. I love to tell the story. I have a client, her father bought shares of Apple 3 days after it went public, 10 shares, and paid with commissions, which were really high in those days. Their cost basis, I calculated because they still hold the shares, is 14 cents per share. And it's 2,240 shares. So Apple's dividend is more than the stock basis. But that's, you got to participate back then. If you got into an IPO like that, you got to participate in growth because companies came public and they were worth 100 million. I don't know what Apple's worth was, but let's say it was around $100 million. Now we have remember when Airbnb went public, it was like $100 billion company already. So much of the growth has already happened before it's even available in the public market. That's a big change that's made it even harder to make money in IPOs.
I think that's another, in addition, everything Kirk just said is the reason value doesn't matter anymore. And I think what you just said hammers home why small caps have just gotten no attention whatsoever, because all the good ones are staying private until they're not small caps anymore.
Yeah, no, that's a fair point.
Yeah, it's definitely, the markets have changed a lot. You could say that they're broken. I don't know if they're broken or not. I would say they've been broken for a long time. I mean, when you can't, when you have, I think we mentioned it on the interview, it's overstock.com, and the guy there who was just like, I'm not marching to the drummer of Wall Street. I'm doing my own way, and Wall Street's headed out for him ever since. They've had it out for him for years and just doing whatever they can to just squash him. And I just think it's funny. I mean, the guy's like a libertarian. He's like, yeah, I'm doing my own thing. And Wall Street's like, no, you're not. But then you got companies like Google that do their own thing. And Wall Street's like, oh, well, we'll do your bidding because it's a tech company and they need them. Right. And so, I think the whole industry, the financial industry needs to change in a significant way. And I think it's slowly doing that, but it kind of gets to a point where a lot of this kind of stuff, like the IPO market, why do we even need the IPO market set up the way it is? Why not just have a Dutch auction? Why just have it differently? Well, because the investment bankers won't make all the money that they're making, or they can't guarantee a minimum bid of whatever price, right? Because that's how they get the business. Oh, I guarantee we're going to get you at least this. So the whole industry is just kind of self-incestuous, and I think at some point that has to change, but it's hard to say what's going to do that. Technology, I imagine, is going to be the biggest factor in change. But
well, why don't the big firms in the 401k plans stop using mutual funds? There's too much money in it.
You're right. There's too much money in it. Well, yeah. Well, it's also because they can hide their fees in the mutual fund expense ratios.
Yeah,
it's a big part of it.
Yeah.
You know, because after that, the plan participants will no longer be able to say, no, I don't have any fees in my 401k. I should keep it there. There are no fees. Oh, really? Right. They're doing it for free? Okay.
Yeah.
Good luck with that.
I just did my textbook event, Current and Future State of Investing. And I've got a slide that shows, like, here's the expense ratio of your mutual fund. Here's the expense ratio of a comparable ETF. And then on the next slide, it shows like the 5 different fees that are inside the mutual fund and all the same categories for the ETF, but only one of the categories actually has a number in it. The rest are all 0. There's no distribution fees. There's no admin fees. There's no other fees. It's just the management fee. That's it. But yeah, I mean, it's like you're saying, like IPOs, the investment bankers got to get paid. And, you know, all the advisory firms and the 401k plans use mutual funds because they got to get paid, and they can hide the fees even worse.
You know, you talk about those fees and the range. I recently did a presentation too, and I was looking at just a simple S&P 500 index fund.
Yeah.
And I found the low end is 0.02%. The high end, it's like 1.37%.
Yeah.
It's the exact same fund.
Yeah.
But you get it from one source, you're paying 0.02, the other you're paying 1.37. And people don't know because, like you said, it's hidden. People don't, you talk to people about expense ratios, they don't even know what they are or where they come from.
No, because they don't get shown on statements. Out of curiosity, the one you found that was 1.37%, was that a retirement share class?
No, it wasn't. It was just a regular one. It wasn't even a retirement share class.
Interesting. That's crazy. 1.37%. I have a couple of clients that used to work for a company that they no longer work for, and they had a 401k plan with a firm whose name I won't mention, but inside of that 401k plan, they had an S&P 500 index fund for 66 basis points. And I'm like, VOO costs 0.03%. Where do you think the other 0.63% is going? It ain't going to you.
No.
Yeah. So.
Well, I think it's kind of what we talk about in the show. It's you know, low fees. We beat up low fees in the show all the time because it's not the low fees, it's how people put it into context. So what we're talking about is a fund that is all together, for all intents and purposes, the same. All these funds are the same. S&P 500 index. They have to track the index or else nobody's going to put money in it. So realistically, they're all the same. So yes, you have to pick the lowest fee if they're all the same. But if you're comparing the S&P to like bonds or like real estate or whatever, it's not the same, right? So paying higher fees for something else is less important, right? You're looking, it's like, perfect examples like GBTC. It's like a 2% fee a year, right? And people are like, oh, that's too high. How else are you going to get access to it, right? And how else are you going to get access that tracks the performance of it? So if you want access, you don't have a choice. I'm happy to, and if you're paying 2% compared to like, 100%, negative 70% swings, and you're looking for that, then it's worth it, right? Because what's 2% if it goes, this year they're up, 100% plus. I think one of them's up like 200% or something crazy. But the point is what's 2% in the scheme of like 100%? Well, it's very small, right? But if you're talking about 2% in comparison to 10%, well, that's a big deal, right?
Yeah.
So it's totally dependent upon how your portfolio is constructed and what you're trying to do. But if all else is equal, fees are very important, but rarely is all else equal.
Right.
And I think that's the thing that people need to keep in mind.
We have that conversation all the time, Kirk. You know, I'm a big believer in factors. And so it's like, it's rare, but sometimes I get the question like, why is this S&P 500 ETF so cheap? And then all these factor ETFs are more expensive. And it's like, okay, but they're still really cheap. I mean, they average like 0.15%. Compare that to an active mutual fund at 0.7. They're still very low cost. But to your point, a quality ETF is not doing the same thing as an S&P 500 ETF. You would pay 0.15 for the quality ETF instead of 0.03 for the S&P 500 ETF because you believe in the long run quality stocks will do better than the market. And so that's why you would pay that higher fee. So that's an important distinction. It's interesting because we talked about GBTC before. I hadn't looked at it in a while. It's funny that their expense ratio is still 2%. So they didn't change that after BITO came out. And I wonder if they'll stay strong if this new Bitcoin ETF gets launched. Total side note.
Yeah, we'll see. I think the expense ratio is going to come down, but it's hard to say, right? I mean, if you think about what has to happen, so this is the interesting thing with crypto, right? Because you have to think about what has to happen in order for it to do it. Well, one of the reasons that they have a high fee is because they have to use cold storage, right? You have to set that up, you have to structure, you can't just leave it on exchange. Like there's a whole bunch of stuff that goes into that. And I'm very curious. I know these companies have put a lot of time, effort, and thought into making sure it's secure because, I mean, they've been doing it for like 5 years and no one's been proving them. But still, like, I think they put a lot of thought into it. But I do think it'll come below 2. I think 2 is because it's the only one out there and they can get away with it. I think they can probably get it down to 1.
Well, that's so the other thing I was going to mention earlier and just kind of jumped out of my head in terms of like why people are still in mutual funds, things like that. I mean, anybody that's been investing for more than a cup of coffee, what are you going to do? Like take your money out of GBTC and put it into a new Bitcoin ETF and pay $75,000 in capital gains taxes? GBTC is not stupid. They know that the early adopters have got massive capital gains embedded in there, and they'd rather just keep paying the 2% fee than have to fork a bunch of money over to the government.
Yeah. What are your thoughts, Phil?
And then talking about the other fee too, and you have that mutual fund thing. I have clients that have mutual funds they've had for a long time. It's not just the fact that they have gains if they get rid of them. It's also that they tend to reinvest. So they only make the problem worse, right? It's because mutual funds make these big distributions. You have to pay tax on them. Doesn't matter what the fund did. You still have to pay the tax. And clients will say, well, why do I have to pay estimated taxes? I'm like, well, you own all these mutual funds that you owned before I got there because I don't use them, right? And you're reinvesting the dividends and only making the problem worse.
Yeah.
And I mean, we have one client, we've been clearing out mutual funds because if we look at the rates, they're okay with paying the tax because they had several $100,000 of capital gain distributions last year. We want those to go away because it makes it so much harder to do planning when you have these big numbers that get thrown into your return at the end of the day too.
Yeah, we had a client come in early last year, a little over $2 million worth of mutual funds. He was getting $66,000 a year in capital gain distributions because that was how much was outside of the IRA accounts. And so we sat down and went through a whole bunch of numbers. And I was like, we'll take you out a little bit every year so you don't get hit with too big a tax bill on each individual year. And he actually came back to me and was like, I ran these numbers. And if I take the whole thing, then this is what it'll do to my tax bracket. And these are all the numbers I ran and all of that stuff. And he said, what do you think? And I said, well, if you've got cash sitting in a bank account to cover the tax bill, then by all means, I would hate to see you take a big slug out of your investment accounts just to get it all done in 1 year. And he came back and said that he did in fact have the cash. So he took $180,000 in capital gains in 1 year. And now he's 100% ETFs. And other than what we do from a rebalancing perspective, he doesn't get any of these cap gain distributions anymore. So it takes a certain kind of person to say, you know what, I'm not going to be held captive in this thing just because I've got big cap gains embedded in it.
Yeah, and it makes such a difference once you take those out, and that planning becomes so much simpler because you don't have to worry about like what the mutual fund is going to send to you.
It's like ripping wallpaper off the wall. Like, yeah, it doesn't look great when it's done, but once you paint it, it looks nice.
Yeah, exactly.
Awesome. So, all right. So let's wrap it up here. Phil, final thoughts from you.
IPO market, it sounds exciting, but it usually isn't. If you want to invest, got to be careful, right? Don't go in expecting gains like you've heard people got in the past, because it's unlikely that you're going to see that. And just be careful. And thanks for having me today, Kirk. I work with people experiencing big life transitions, which I know can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. You can download my free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for my weekly blog. Thanks again for having me today, Kirk.
Great. Thanks for coming on, Phil. And Tim, final thoughts from you.
Yeah, I would agree. IPOs, I think, have more flash than substance. And I think you alluded to it earlier, Kirk. I think a lot of people like the idea of an IPO because it's the idea of an IPO. They hear that they're going to get an outsized return. As I said earlier, my personal view would be, given all the changes in the marketplace and greater accessibility, if you have the accreditation, start looking at things like private equity instead of IPOs, because I think Phil's right. You do have to be careful. You know, a lot of this stuff gets sold by investment bankers. Let's figure out a way to get this thing out the door and get maximum pricing. Whereas with private equity, nobody has to worry about that. They're just doing everything they can to improve the firm. So that's the route I would go. You know, again, Tim Baker, Metric Financial. You can find all of our information at metricfin.com. You can sign up for our weekly newsletter that comes out every Saturday morning and is basically a summary of what happened in the market, and a couple of investing and financial planning tips. We do that every Saturday morning at 8, so you can read it while you drink your coffee. Again, metricfin.com. And thanks as always for having me, Kirk.
Great. Well, thank you both for coming on the show.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.